Strategy Management Series. Video number 74, Strategy Formulation. Step 6. Strategy Selection, the Shell DPM Matrix. Welcome back to the Ready MBA series on strategy management. In our previous videos, we have been discussing strategy selection, the sixth step in the strategy formulation process. This step consists of identifying and selecting courses of action that a company may choose to achieve its strategic intent, mission, vision, and objectives. To help define those, the planning team can leverage generic strategies and strategic frameworks. Generic strategies are fundamental approaches that businesses adopt to gain a competitive advantage and position themselves effectively within their industry or market. Strategic frameworks are analytical tools that help the planning team visualize the specific conditions in which the company finds itself, and based on their results, enable the company to identify potential strategies to be executed. In our previous episodes, we covered different groups of generic strategies such as Porter's generic strategies, diversification strategies, integration, cooperative and acquisition strategies, as well as restructuring and disruption strategies. These generic strategies help businesses make strategic decisions about how they will compete in the market, allocate resources, and differentiate themselves from competitors. In this video, we will continue reviewing different strategic frameworks to identify the most appropriate generic strategies to be considered by the planning team given internal and external market conditions. We'll explore another powerful framework for strategic analysis and decision-making, the Shell Directional Policy Matrix, DPM, created by Shell Chemicals in 1975. It is a traditional portfolio analysis tool that helps organizations identify their strategic options, and it is a refined version of the BCG Matrix. It evaluates a company's strategic options based on business sector profitability and company competitive capability. Imagine a two-dimensional chart where the horizontal axis represents prospects for business sector profitability, and the vertical axis represents a company's competitive capability. Now, let's break down the components. Business sector profitability encompasses the market size, expected growth, lack of competition, profit margins, and favorable political and socio-economic conditions. It's about understanding the industry's financial landscape. On the flip side, a company's competitive capability is determined by its sales volume, product reputation, reliability of service, and competitive pricing. It's all about how well the company can perform and compete in the market. Now, let's break down the steps to position a company on this matrix. First, identify key profit drivers for the sector such as market size and growth, competition and industry trends. Analyze financial performance and conduct market research to collect as much factual evidence as possible. Remember to also consider the relative performance to other sectors or industries as a benchmark. Rate each one of those drivers in terms of attractive, average or unattractive, and then define the average rating for the business sector profitability. This average score defines the position on the horizontal axis. Now, shift to the company competitive capability on the vertical axis. Competitive capability is measured in terms of strong, average, or weak. Assess sales volume, product reputation, reliability of service, and competitive pricing. Gather as much factual evidence as possible to eliminate qualitative biases. How does the company perform against competitors? This evaluation is crucial. Then rate each of the company's capabilities as strong, average or weak. Take the average of all evaluations and this score defines the position on the vertical axis. With these insights, let's plot the company on the matrix. On the horizontal axis, attractive sector profitability is to the left, and on the vertical axis, above average competitive capability is higher up. Interpretation time. The matrix has 9 cells, each with a distinct meaning. Now, let's explore the disinvest cell, which represents a company with low competitiveness in an unattractive business sector. If an organization finds itself in this quadrant, it means it's running in losses with uncertain cash flows. The situation is not likely to improve in the near future. In this scenario, the organization should consider divesting. This could involve liquidating or moving assets. Generic strategies implemented here are divestiture and liquidation. It's about shedding non-core businesses or assets to focus on core competencies. Another option is seeking partnerships for divesting businesses in a mutually beneficial way. General Electric, GE, for example, divested its biopharma business to Danaher Corporation in 2020 to optimize its portfolio and focus on core businesses like aviation, power, and renewable energy. Moving on to the phased withdrawal cells, which are the only ones to occupy two positions in the matrix. Here, the organization is either in a weak competitive position in an average growth market, or has average competitiveness in an unattractive industry. In both cases, the organization has very little chance of generating cash flows. The suggestion is to phase out gradually. The cash realized should be invested in more profitable ventures. Strategies may include restructuring, retrenchment, divestiture, and liquidation, depending on the organization's specific situation. It's about planning a gradual exit while maximizing value. Kodak, once a leader in photographic film, faced a decline with the advent of digital photography. The company implemented a phased withdrawal by gradually exiting its traditional film business and shifting focus to new ventures. Now, let's talk about the double or quit cell. In this quadrant, organizations face a gamble. Their competitiveness is weak in a very attractive industry. They might have major unrealized, but also uncertain, potential for the future. The decision? Either invest more to use the prospects presented by the market or quit the business. Strategies could involve assessing and streamlining the product-service portfolio for maximum efficiency. Companies facing challenges may consider restructuring, retrenchment, or divestiture to optimize their portfolio or exit unprofitable ventures, and double down on acquisitions, partnerships and integrations. When faced with the competition of iOS and Android smartphones, Nokia Corporation exited the cell phone industry completely and successfully reinvented itself in telecommunications infrastructure, showcasing adaptability in response to market dynamics. Next up is the custodial cell. Organizations here are like cash cows, milk it and do not commit any more resources. It's time to focus on maintaining stability and efficiency. In a corporation, getting help from other business units or exiting the scene to focus more on other attractive businesses could be the strategy. Investing in brand building and customer loyalty is key here, along with operational efficiency to generate steady cash flows. Blockbuster, once dominant in video rentals, adopted a custodial approach by focusing on its traditional in-store rental model amid the rise of digital streaming. The strategy aimed to preserve the brand and existing business, but Blockbuster's reluctance to embrace digital innovations ultimately contributed to its decline and bankruptcy. Let's explore the try harder cell. Organizations in this quadrant could be vulnerable over a longer period but are fine for now. They need additional resources to strengthen their capabilities. The strategy involves implementing cost-cutting measures and operational efficiencies to compete more effectively. Identifying and catering to specific niche markets to differentiate from competitors is also crucial. Companies aiming to try harder can form alliances to strengthen their position. Integration strategies can help try-harders expand horizontally or vertically. BlackBerry, once a dominant player in smartphones, faced challenges. The company attempted a turnaround by focusing on cybersecurity and software solutions, trying harder to regain relevance. Now, let's talk about the cash generator cell. Here, organizations may continue their operations, at least for generating strong cash flows and satisfactory profits. No further investments are made in the stagnant industry, other than for maintaining a strong market position. Strategies may involve distributing cash to shareholders through dividends or prioritizing debt reduction to enhance financial stability and flexibility. Cash generator organizations may also consider generic strategies like restructuring, retrenchment, or divestiture to optimize their portfolio. Expansion to global untapped markets or horizontal diversification are also strategies that companies can pursue. Johnson & Johnson's position as a cash generator is rooted in its diversified healthcare offerings, spanning pharmaceuticals and consumer health, which ensures stable revenue and the ability to sustain dividends for investors. Moving on to the leader growth cell. Organizations here need funds to support product innovations and R&D activities. Strategies may involve pursuing strategic mergers or acquisitions to accelerate growth. Forming alliances with complementary businesses to expand offerings and markets is also a viable option. Potential generic strategies include related diversification and unrelated diversification, as the organization in a strong competitive position can explore diversification, either related or unrelated, to drive growth and capitalize on their leadership position. Microsoft, a global technology giant, consistently invests in research and development and strategic acquisitions to introduce new products and services. Innovations such as Windows operating systems, Office Productivity Suite, and Azure Cloud Services showcase its commitment to staying at the forefront of technology. Next, let's explore the market leadership cell. Major resources are focused in this quadrant, making it a top priority. Strategies include focusing on continuous innovation to maintain a competitive edge. Global expansion is also on the table, exploring opportunities for international market expansion to solidify leadership globally. Market penetration, market development, product development, and diversification are often suitable strategies for the market leadership cell. Integration and acquisition strategies can help leaders consolidate their position. Amazon, a major player in e-commerce, prioritizes its e-commerce business. The company continuously innovates, expands globally, and explores new markets and product categories to maintain market leadership. The Shell TDM matrix has limitations, including oversimplification of complex realities into a two-dimensional framework, subjectivity and score assignment, and a static nature that may not capture dynamic business environments. The matrix offers generic strategies and relies on historical data, potentially lacking specificity and adaptability to industry-specific nuances. Despite these limitations, it provides a useful snapshot for strategic analysis when complemented with a nuanced understanding of the business context. That wraps up our exploration of the Shell DPM matrix. Remember, the strategic landscape isn't always boxed, it's dynamic and interconnected. Join us next time as we explore more strategies and frameworks. Thanks for tuning in.